Hey everybody, good afternoon. Before we get started, there's a chat icon on here where you can, I know some people have been using the chat, but since this is going to be about taxes, I think it would be fun to know what entity structure is your business currently operating in. So let us know if are you a sole proprietorship, corporation, S corp? Drop that into the chat. That way, Olivia and I can know, what most of the crowd is working with, so we can also direct our attention to those types of entity structures. All right, yeah. So we'll get started. As a lot of you know, I am one of the owners here at Cycle CPA, where we do anything from bookkeeping to CFO to tax services, and we just specialize in the green industry. And I'm super excited because this is our first ever tax webinar, and it's a great time of year to talk about that. And I applaud a lot of you guys that are on this call, and thank you for being part of this call because you are taking a proactive step in getting your taxes in order and getting information on that. So proud of you guys for joining us. I know it's not the most exciting topic, but it's definitely necessary. And so I also want to present Olivia Gutierrez, who's on the call with me. She's our tax manager here at Cycle CPA. She's just great. And I'll hand it over to her right now.
Thank you, Carla. Hi, it's nice to see everybody. It looks like as if a lot of you are S Corps and single owner LLC, which is primarily a lot of what I've dealt with. As Carla mentioned, I am the tax manager here and I'm an enrolled agent. I've been doing taxes for business owners and individuals for almost 20 years now. So when I tell you I've worked in many industries and I've saw best case scenarios, worst case scenarios, nothing really surprises me too much now.
That's awesome, Olivia. And I just want to few housekeeping things just before we get started. This will be recorded, so don't worry about taking too many notes. You'll get a recording of this. And please ask any questions along the way in this chat box here. All right. But yeah, we could get started, Olivia.
Okay. So today, what we're going to kind of go over is just a few tips, and it's just kind of to help the businesses of what to look for and what to get ready for prior to the year end. And even if this may not pertain to you in this specific year, it might in years to come or even the next following year. So that way you could plan for the future and you could take things into consideration. So today's topics will be 1, the fuel tax credit. We're also going to go over the S Corp wages versus distributions. And seeing this, it looks like we have a lot of S Corps in here. And then we're going to discuss a little bit about the major assets, your purchases and business expenses, and then some certain tax considerations. And the final will be the tax planning, which is something that is very important and that I encourage a lot of business owners to seek into, whether it's with us or it's with their own tax accountants. So the first one is fuel tax credit. In this example of the fuel tax credit, a lot of people don't realize that there's a fuel tax credit for off-road machine and equipment. And in this industry, we know that you have your snow blowers, you have your leaf blowers, your lawn mowers, and what the government does, the IRS, they tax you at the time of you purchasing your fuel. And that's for the road maintenance, for the upkeep. So for anything that's off-road, they give you this little tax credit and it's 0.183% on the gallon. And there's different examples I gave here. For the most part, what I've done for some of the tax clients is I backed into it. So if they told me that their fuel cost was $10,000, I saw it on the books, and assuming 30% was for the off-road here, the $852, they would have received $156 back. What I also have here is that if we do the actual, which is underneath, if the actual was 10,000, and if I was given the average of the United States average of 352, and this is why, sometimes doing the estimated may not be as beneficial if you really track your own actual gallon and what you purchased, because in the $3.52, that's just the U.S. average. If you're in a state that has less cost of the gallon, then if this isn't going to give you as much credit as you probably should be entitled to. But you can see in the gallons for the 10,000, if you were to say that's 100% off-road, the gallons calculate to 2,841, and you can see that fuel tax credit will now turn into $520, and that's 100% refundable back to you. And then using the actual, if you told me the gallon, and I don't have to use that U.S. average, if your gallon was really 3,125, using the same 10,000 fuel costs, well, then you can see how 520 turns automatically into $572 in this situation.
Gotcha. Olivia, so you're telling me like if a business owner is not tracking their off-road fuel, we have to use like this assumption of like 30% they're using towards off-road fuel, and then we have to use the U.S. average per gallon, whatever, right? But if someone is tracking it, then we don't have to use those assumptions, and maybe we could even get a bigger credit back.
That is correct. Okay. Carla, exactly what you're saying, because the actual may be more beneficial, and I normally find it to be more beneficial when you have the accurate amounts. And that assumption of the 30%, I normally ask the clients, how much do you think it is? Some of them might say it's 100% or it's 50% vehicles, 50% off-road.
Yeah, so what we're saying is like, if you spent $10,000 at the for gas this year, then we assume that a portion of that was used for off-road equipment and machinery. Okay. Right. And then one thing that I have for you is a tip. How some people are like, okay, I don't have time to like track the amounts that I use for my off-road fuel. It's hard for me to track that, and we're busy business owners. So how can we do that in a streamlined way? So something that we recommend to our clients is you could have a fuel card that you just use for your off-road machinery and equipment. So you can tell your accountants, hey, if I ever use this card, it's for off-road fuel. So you can categorize it that way on your profit and loss. So you can have a dedicated card just for those purchases instead of having to like track it manually.
Yeah. Yep. And that's a good idea, to be able to track it and then to set something up with the accountants so that the accountants know as well, and they could keep it separated on the P&L, on the income statement.
It says, I have a question from somebody. It says, is this separate from mileage reimbursement for personal vehicles?
It is. So this is a tax credit for your off-road machinery. So this is an extra credit, a dollar credit that you will receive back as a refund. And then in addition to this, you can still take your business mileage and get that as a reimbursement back from the company when you're using your own personal vehicle.
Some stuff.
Okay,
I don't have any more questions on that end.
Okay, and then so the next one would be our S Corp wages versus distribution. And distribution, it applies to sole proprietors. It applies to S Corps and partnerships. What a distribution is the funds that an owner takes from the company, that is part of the profit. It is not payroll. There's no payroll tax on it. And these are just the additional funds that they're taking, which they're entitled to when they're taken out of the profit. But we get a little tricky with the distribution versus wages because when it comes to S Corps, the IRS, they are very particular. An S Corp responsibility is that you are to take reasonable wages. And reasonable wages is an example being if you have 30,000 of wages, payroll, and you take 60,000 distribution. Well, now the IRS, they tend to get a little funny thinking that you're trying to avoid payroll tax. And what they can do is they could come back and say that 60,000 distribution you took and you only had 30,000 wages, the responsibility is to have reasonable wages. What would you pay somebody to do your job? And they could come back and say that 60,000, they can tax you payroll tax on it now because they feel like you took the distribution, you made an S election, giving yourself low wages and trying to avoid payroll tax. So we definitely want to hit a couple of examples here. So that way we know what the IRS is looking for and how to determine, wages versus distribution and looking at the profits. So in my first example, and I'm going to keep it very simple as far as using low figures here. The first example, using 110,000 profit and officer wages, we have a taxable profit of 50,000. Officer wages of 60,000 here. And then year to date, there was 5,000 taken in distribution. So the cash on hand that's allowing for additional distribution here is going to be determined. I would say do not exceed 50% of the wages. So at 60,000, in an example like this, I would always encourage you not to exceed 50%. So that would be 30,000 distribution. You've already taken 5,000 distribution year to date. So that only allows you to have 25,000 distribution if you were going to take a distribution in this scenario. And that's one of the golden rule of thumbs. I always say do not exceed 50% of the wages in something that's minimal like this. And then also you'd want to make sure that this 50,000 cash on hand, that you're leaving enough in the operating bank account. It doesn't necessarily mean you have to take that 25,000 distribution before the year end. It just means it's available there to take it if you don't want to leave it in the operating account or leave it there to be invested into the company or just see the growth cash on hand. So my second example here, still sticking with 110,000 profit and officer wages. Now we have taxable profit of 85,000. Officer wages only took 25,000. So the payroll that was taken was 25,000. And you can see we're still using the 110, the 85 plus the 25,000. And so when you take less than wages, it adds to your profit. Same scenario, distribution taken here is 5,000 for the year, and we still have 50,000 to take as a distribution, payroll. In a situation like this, since the wages are 25,000, I would advise to increase your wages because this is where we get in a situation where you are avoiding payroll tax. And if you took 25,000 distribution or even 30,000 distribution, the IRS could come back and say, well, hold on, you're taking too less of wages. You're saying you're only worth 25,000 in payroll. And this is where we start, getting into that fine line of avoiding the payroll tax. And the IRS can come back and audit, and again, especially the payroll tax.
Olivia. So example number 2 is like going to cause like a red flag for the IRS and saying that you made all of this profit, but you're only taking 25,000 out in wages as an S corporation. It's not like a reasonable wage amount. So that would cause the red flag because the profit is so high, but the compensation for the owner is too low for that amount, right?
That is correct.
Okay.
That is correct. And I mean, every situation, it goes by the owner and what these amounts really are. So it is an individual one-on-one situation. And it's something, again, for the tax planning, if there's any questions, because those reasonable wages, there's a lot of questions that go with it. What would you pay somebody to do your job? How many hours are you really working for the company?
Mm-hmm.
What is your role in the company?
And I think we have, like, because we just work with the specific industry, like we have certain benchmarks too. Like we can advise you on, okay, this is what like people in your area running a maintenance business usually is paying themselves, right? And we have some basis to back us up with that because we work with like hundreds of green industry businesses. So we know what that benchmark is to kind of keep you away from an audit, right? And not raise that red flag. So
it's good information.
Yeah. And then and then the distribution. So you're saying like it should be less than 50% of your wages. If it's more than, like, if the wages are, if I'm taking a $60,000 salary, but then I take a $100,000 draw, that would also raise a red flag because it's more than my salary at that point.
Correct. And, you know, to be honest, all the IRS is really looking for is for you not to avoid payroll tax. So the payroll tax, Social Security starts at $168,600 for 2024. So if we could get you in the neighborhood for a company that's more profitable, let's say they have 400,000 profit, and they have a salary wage of 150,000. Now they can take 150,000 distribution if they wanted to. And that's where the percentage where you start going into another field because you're in a higher tax bracket, you have higher wages, you're not avoiding any payroll tax, and you have reasonable compensation of 150,000. So an example like that for a larger company, they can't take 150,000 distribution.
Gotcha.
Yeah, it's just for an example like this, like the smaller guys. In example one, where he has 60,000 wages, is where you don't want to exceed that 50%.
I see. And then I do have some questions. So someone said, if an owner has a semi-retired and does minimal work, does this still apply the same way?
It does not, because the main questions would be, do they have a manager? Are they paying a manager, a project manager? And if so, what does that look like? And if they say yes, I actually have a general manager who is making $125,000 a year. I have an office manager who is making another $75,000 a year. Right. That says he's paying $200,000 to other managers to do the job for him because he's semi-retired. He took a step back and he's enjoying life now.
Yeah, which I think it's like a lot of our goal. And so then they had a second part to that question. So then in that case, it could it be that their wages would be less than their distributions if that was the scenario?
It would be. Okay. And there's reasonable basis behind it is because they are semi-retired and we can tell the IRS this is his role. This is how many hours. He probably only works 15 hours a week. Mm-hmm. If you were to hire an employee for 15 hours a week, I don't think you would pay them 150,000 wages, salary wage.
Gotcha. I have another question. So what if you don't take the owner distribution, but the profits exceed the total combined salaries?
You can have the profit, you can leave the profit in there, and you can leave the distribution in there, and you're just going to accumulate the cash. The only advice I tell people is when you're building that cash in the company, when I start seeing it hit 200, 300,000, I always warn them. One, it's not insured by the bank. I believe it stops at 250,000 of being insured with the bank. But the most important, if there's a liability, if a customer is suing you because of damage to their property or an employee gets hurt on the job, that fund, the 200, 300,000 that you're leaving in the bank account is open for exposure and for a lawsuit. So you're opening the books for somebody to come take your money. And that's the profits that you've had building and accumulating over the years that you're already paying taxes on. So I always say you already pay the taxes on it. over the past 4, 5, 6 years. So you might as well take some of those funds out and put it into your own personal investment if you want to invest and build interest or dividends, or to do as you please with it.
Agreed. Just reading another one here. Someone said, if you're switching to an S corp after years of being a sole prop, will the IRS look at the former tax record to see what the owner paid themselves compared to the new salary?
No, because if you're an LLC, a sole proprietor, you don't have any wages or salary. Partnerships and LLC sole proprietors are never allowed to put themselves on payroll. So they should never have payroll. They should never have wages. They only take distribution from a partnership and a sole proprietor LLC.
Awesome stuff. Thank you. That's all the questions I had.
Okay. And then the last thing would be a lot of S Corp owners, and I've ran through this over the years, in my experience, is that you have to do distribution based on your percentage of ownership. If not, the IRS could revoke your S corporation and make you be a partnership, or go back to being this one has multiple. So you'll default as a partnership, which will make you subject to self-employment tax on your profit. And you don't want to get in that situation. So for the ownership, using the 50,000 in this example is, if owner one is 65%, they are to take 32,500. Owner two is 35%, so they are to take 17,500, and using just the 50,000. In a 50-50, it would be 25,000 for each partner on the bottom scenario here. And this is just something that's very, very important, because again, when you do not distribute by the ownership allocation, they can revoke your S corporation status. Okay. And this one here, this is the stuff that I like to advise business owners to get ahead of prior to the year end, prior to even starting their tax return. And it's major assets and business expenses. My first one is reviewing your fixed asset list. And I'm going to share my screen just so we can see exactly what I'm speaking of. I highly encourage owners to look at their fixed asset list, and they should obtain it from their accountant and see what they have on this list. If there's any disposals, you definitely want to dispose of it. You want to scrap it. There are certain states that have personal property tax return, such as Maryland, Michigan, Indiana. We have personal tax returns, which means you're being assessed a tax on all your assets that are listed on the sheet. And if you're a part of that, where you have personal property tax, you definitely want to dispose of assets that you no longer have. Now, I'm not going to tell you to dispose of them just to get out of paying tax, because in an audit, if they find that you still have the equipment, you're going to get a penalty there. But I definitely want you to take a look, because I've seen people who have computers listed all the way back to 2009. I'm not sure about most people, but I personally don't have a computer from 2009. And I don't think many people would, but there are still some people who may. Another thing to point out here is that you can see all the assets are 2023. What if you purchased something, say in November or December, and you financed it, and your equipment is worth $40,000, but it's financed? We're not going to see it. We're not going to catch it, because your first payment will not be made until early 2025. Now you just lost that $40,000 purchase as a deduction, and it benefiting you tax-wise. So you always want to bother yourself with this tax asset to just see what it is that's listed here, and to make sure that we didn't miss anything. Because if you go pay cash for something as well, say Facebook Marketplace, we're not going to see that either. Or if you pay with your personal funds.
Yeah, I agree with you, Olivia. Like, this is a big one. Like, even with the business owners we work with, we're constantly reminding them, like, send us the sales receipt or the loan agreement if you did purchase, like, a Ford F-250 or a skid steer. send us that information, because we know that that means that you may be losing out on depreciation that year. So that's why you need to just take a look at this right now before, your tax accountant starts preparing it. Because if there's outdated equipment there, you're paying, on that, or if you're missing something, then you're losing out the expense on that end. And like, I know a lot of people will like finance something personally or something like that. We're not going to be able to see it in their business bank account. That's where we miss stuff as accountants. So no, that's a great point. I can go back to the slide now.
Okay, well, I'm going to show the next one.
Okay.
So I'm going to share one more, because the next one would be distributions. And I highly, highly encourage all business owners to go through their distribution account. And this is an actual example of one of my clients. I can't tell you how many times I get to the bottom line and I say, this is your profit tax-wise. And you took 80,000 distribution during the year. And they sit back, no, I didn't take 80,000. Never did I take it. But when we see things like this, like Kroger, third line down, it looks like it's grocery store stuff. Maybe you purchase groceries for the family. But as you can see, this certain client, he came back and he wrote shop supplies, cruise supplies, worker wage, job supplies. So these are things that we just put into the distribution, which again is your personal account. What we're saying is your personal account, your personal purchases, but you do want to review this to make sure there's no business expenses that made its way here.
Yeah, because your accountant, like, as your accountant, we see Sam's Club, we're like, oh, they went grocery shopping with the family. They brought cereal and their chicken for the week. I don't know. But it ends up being job supplies. Like, we would never know that. So yeah, like it's incredible how much money you can lose out on if you're not looking at this distribution report. So it's something that you should look at every month, but at least at the end of the year, to make sure that you're not losing out on all this, expenses on your P&L.
Yeah, I agree. Okay, and then we can go back to the slide now.
Okay.
I'm going to stop sharing. And then the last thing, of course, keeping in mind out-of-pocket expenses. Again, we don't know what you're spending if you're using your personal funds, such as your personal credit card, your personal debit card, checking account, cash. We don't see that, and it's not going to come through your business checking account. So you definitely want to review and take a step back to say, did I make sure I turned in all my receipts, all my reimbursements to the company for whatever I may have paid for personally?
Yeah, I know it happens to me sometimes, and I'm an accountant. Like, I'm at, UPS, I'm shipping something. I forgot my business debit card at home, and now I'm using my personal account, and I'm like, well, great, this is not going to be recorded on my P&L now, but we can still manually record it with the receipt.
I agree. And then something that is normally out there for tax considerations is your home office. And for the home office for a sole proprietor, what we're going to do is we will add that to your personal tax return on your Schedule C. So that way it lowers that taxable income for your home use. And what we do is that we'll ask you for your square footage for the entire house, your square footage for your office space, and then we're going to expense your utilities, insurance, real estate, tax, the mortgage interest paid, or your rent, depending if you own or if you're leasing. And in this little example here, this little box, you can see how this person told me that they had 900 square feet for the garage that they use for storage for all their equipment and supplies. They also had 200 of office space. So the total here is 1,100 square foot that they're using on their personal home. Their personal home is only 3,800 square foot. So the calculation on that is almost 29% of savings. So we're writing off 29% of your utilities, 29% of your rent. This could quickly add up, and you definitely want to capitalize on this and make sure that you're doing this appropriately for your home office. Now for an S Corp and for partnerships and C Corps, it's going to run a little bit different. There's two methods that I like to use. One is the reimbursement method, where we actually do this calculation here that I just referred to, and then you come up with something that's reasonable. We'll take your actual utility bills, your square footage, and if it only comes out to $325 a month, now we're going to cut reimbursement. And it's because if we were to really get audited on this and say, IRS said, well, you are paying yourself, this is rent, well, we have a calculation to zero it out. So this is within reason. It's actually a reimbursement. It's not rent. The other method would be the rent method. And the rent method is that you're going to pay yourself a monthly fee. You probably aren't going to care too much about this calculation here of the square footage or anything, and might just give yourself an assigned, say, $1,000 a month. In a situation like that, you'll take the $1,000 a month. Well, 1099 you at the end of the year, the $12,000. But now you got to schedule E on your personal tax return. And then this is where the calculation comes back into play. And maybe after the calculation and you paid yourself $1,000 rent monthly, now with the calculation, maybe you have a profit of $3,000 for the year on your rental. In that situation, you're paying yourself rent. You have the profit on your rental property now for the $3,000, but it's not that it's building any additional tax because you're just moving from your S Corp or your business to the rental. So it's just moving from one line to the other. So there's no big deal with it, no harm. And the last thing I could say about the home office, and I put it in caps here, you have to be sure you do not have a physical office location. And the IRS is very particular about this because if you have an office location, you have a warehouse, you have a business office, they now say you're only working from home out of your convenience, and they disallow this expense. So that's the number one question that I will always ask you. Do you have a physical location where you have an office, you have a business space, you have a space where your employees go and clock in for work?
Awesome stuff. And then somebody asked, isn't there a max square footage amount for a home office expense? And the answer is no. You just have to have a good basis in this calculation and use one of these methods to come up with that amount.
And then and we're going to wrap it up with the tax planning. Now, this is the fun part. I enjoy this part. Tax planning, if you don't do tax planning with us, which we offer tax planning, whether we're preparing your taxes or we don't prepare your taxes, we can always take a look to see where you are and how it's going to affect you bottom line. And you'll see with the next screens exactly what I'm talking about when we do the tax planning. We do offer it for $375. Again, we don't have to prepare your taxes, but if you don't go through us, I highly advise you to go reach out to your tax accountant, and you should be doing this at least once or twice a year. For business owners that have more profit and more profitable, I would say maybe about 300,000 range, you should probably meet with your tax accountant at least on a quarterly basis to make sure you're paid in full, you have your estimates, and you have everything up to date. So when we do the tax planning, we determine your taxable income, your book to tax. We also like to maximize your tax savings, such as retirement and the HSA contributions. And then my favorite one is, do I make a purchase by the end of the year? So just looking at the taxable income, you can see how quick your book profit, and this is my example, your book profit, what you log in, you see on QuickBooks Online or your accounting software, your $139,000 profit here, almost $140,000. I take this book profit and I turn it into a taxable situation. We add back your donations. This one's a cash basis, so the undeposited funds, it's actually going to reduce this book profit here. So we reduce it by the undeposited funds. We add back 50% mills, and we're going to add back the book depreciation because, again, the depreciation that you're seeing on your books is book depreciation. It's not tax. So you can see how this $139,955 quickly turns into $184,978 taxable for 10 months. If I do the monthly average, it would be $18,498. And if I say, if you continue to run this way for November and December and have the same profits, now I'm estimating your annual income to be $221,974. Now I'm going to take a look at all your depreciation and what kind of tax advantage we can take. For this person, they purchased assets in 2024 for $3,850. Of course, I'm going to do Section 179 on this. But you can see they didn't have major purchases here. And the prior year depreciation is only $2,356 because what they did was with their purchases in prior years, they took that aggressive tax depreciation. So you can see how the book depreciation up here of the $43,000 only really means it's about $6,000, $6,100 tax depreciation down here. So now that we took the $139,955 book profit, and now your taxable income, we're estimating $215,000. So that $215,000, this is where I say, if you don't do tax planning, I would highly recommend you start doing tax planning because that $139,000 quickly turned into $215,000 taxable income. And you never want to have this come up behind the scenes. I feel like something's going on my screen here.
That was me. I was just trying to point out the difference.
I was so lost. I didn't know what happened. I thought somebody was pushing buttons like they didn't want to hear the $215,000 taxable income.
No, I just think it's like, it's just a great thing that you're pointing out, Olivia, that like on your P&L, you can see this 139,000, but then after, and then that's through October, right? But then after you add back and take out all the taxable situation, like donations, the 50% of meals, the tax depreciation, it quickly, like now your taxable income is 215,000. So, it really helps you see what you're going to have to be paying taxes on it, for the 2024 tax year, right? So it's not really just looking at your P&L and thinking, okay, that's what I'm going to pay taxes on. It entails so much more than that. So that's why having these tax planning meetings during the year brings so much clarity. And now you don't have to like stress out, in February or March, April, when you have that surprise, at the end, at the beginning of the year. So.
Yeah, no, I agree with that. And, with the tax planning, your tax accountant, they should take this $215,000 and put it in your personal, but they should also look at it as a whole piece. Maybe the spouse works and they have $100,000 salary wage. Maybe you have some children and you have some child tax credit. So you really have to look at it as a whole picture, not just focus on this $215,000, but what does this $215,000 mean to your personal tax situation?
Yeah, because the business and the personal do affect each other, right? For the tax. Do. Yeah.
Unless you're a C Corp. A C Corp is the only one that doesn't pertain to this because they have their own individual tax. But I don't recall seeing anybody say that they were a C Corp that's in here right now.
Not that I saw.
And then I did see here, at what time a sole member LLC should you change to an S Corp? That's a really good question. My first question is, do you already run payroll? Because when you become an S Corp, now you're responsible for payroll tax and the payroll tax filing. And if you say, yes, I already have employees that are payroll, I say, let's take the next look. But I normally recommend maybe around in between the range of 125, 150,000 is when I start entertaining looking at you converting to an S corporation. Okay. So now that we have that 215,000 taxable situation, we want to know how can we save and what can we do before the year end. The first thing that I want to point out is the HSA Health Savings Plan. This is for people who have a high deductible health plan. So the high deductible health plan, you can use this HSA. I always go with an HSA. I never go with the flexible because a flexible is more or less use it or lose it. HSA, you could save, and you could save for many years going forward. And the maximum amount that you can contribute is $4,150 if you're single, $8,300 if you're family coverage. And you also get an additional $1,000 contribution catch-up if you're 55 years or older. And with this, you can use this HSA to not only pay for your copay, your prescription, vision, dental, but you could use it for your everyday use. And I'm going to show you a screen because you could see what's HSA eligible. Let me go in here.
So for the 8,300, so you don't lose that if you don't use it all in 1 year. You don't lose it.
You don't lose it at all. And the good thing about this is that not only do you not lose it, but any type of earnings that you have, like interest, dividends, all those earnings are tax-free, and it will remain tax-free as long as you use it on your medical stuff, your copays, your vision, your dental, these everyday use. And this is something, and I pulled this up from Amazon because I'm a big Amazon person personally.
Yeah, it's not using Amazon nowadays, right? It's so convenient.
Yeah. And you can see right here, when you click on the FSA or HSA eligible, it's going to show you everything that's eligible. And if you look right here, the eligible, it's going to say it right underneath. But these are everyday use stuff. Dayquil, Tylenol, the Band-Aids, some lotion.
We were just joking earlier, like the massage gun, you know, it's funny how even the Tums, it's funny how all of these things are qualified under that, like everyday household items that you would get, like your, like your Advil, stuff like that. I think that's great. And then who doesn't want to save taxes? And then, you're just doing your everyday shopping almost.
Exactly. Here's my favorite Prilosec. I'm hitting an age, I'm starting to get my Prilosec now. But these are just like everyday uses that we don't even think about. You wouldn't even think that you would be eligible. We could go back to the PowerPoint. But things like this is just to take into consideration. I used to have a high deductible health plan, and I wanted to try to get my taxable situation lower. So I did the maximum contribution in the HSA, and then I used it for my everyday life and then for my co-pays and whatever I needed. Mm-hmm. Because again, all the earnings in this is tax-free as long as you don't use it for anything else. Now, if you use it for like grocery shopping, you're going to be exposed to this 20% penalty. So use it for what it's for. Again, like you said, Carla, it's not a use it or lose it. You could keep saving. If you don't use it by the end of the year, it just rolls over to the next year. And then it just keeps going forward. And I think you and I, we were discussing event life, like having a baby and preparing for that and using the savings to pay for that. Or even, we never know what happens down the line. Mm-hmm. You can keep this, and, as you get older, you might start having more health issues. So you're just saving. And this is actually used. You could go to your local bank to start an HSA, and it works just like a checking account. They give you a debit card. They give you a checkbook. You have your balance. You have it online. And for the most part, a lot of places, they give you an app. So you can actually scan the barcode to see if it's eligible. Oh. And I had mine through Centur here, a local bank, and I could scan it. But not only that, I could actually scan, and it will save and attach to the receipt every time I spent it.
Oh, nice.
Yeah. And the other good thing about this is you can actually withdraw at 65 years old. So at 65, you have the savings, let's call it $30,000. You could withdraw it for any purpose without penalty. And the IRS says this is okay. You made it to 65, take it, and we don't care what you do with it. And there's no penalty on this. The other one would be retirement plans. I'm big about the retirement plans because as a business owner, you want to contribute. So if you can contribute, you can see the 401k and the solo 401k, you can contribute $23,000. Of course, you have your $7,500 catch up for 50 plus, and the maximum at $69,000, and the other one is $76,500. I always say, take your money. If you took $23,000, you're just putting it to the side for later on, for your later use, and you're not paying the taxes. Because the theory behind this is, as you're having the wealth now in your younger age, you're in a higher tax bracket. Take that $23,000 when you retire and take it for the distribution. That's when you're taxed, and you're in a lower tax bracket at that point. We also have the SEP contribution, which is 25% of employee wages, $69,000 max for business owners. We have the simple IRA. Your contribution is $16,000 plus $3,500 for the catch up. And then we also have the traditional. If you do not offer your employees a retirement plan, you're going to have to go with the traditional, because you can't set up one of these plans and not offer it to your employees. So in that situation, you would go with the traditional. It's the $7,000 contribution, $1,000 for the catch up. Now, what I have also done in some of my tax planning meetings is that the Roth IRA, it is not pre-tax. It's not going to save you taxes. But what will save you taxes is if you have a child who is 7 years old and older, if they come to your office, they help you clean the office, maybe do the maintenance work outside, do some filing for you, you could pay them wages. And then you could pay the wages. And then with the net income, you can put it into their Roth IRA. And it starts at 7 years old. So when you put it into the Roth IRA, now it's building for your child. And you get the write-off because you pay them wages. So now it does deduct off of your bottom line profit. You paid your child some wages. You put it into the Roth IRA, and it's sitting there for 5 years plus. They could use it for their college tuition. They could use it for their first home that they purchase. And it's going to have the growing. And that growth, again, will remain and stay tax-free.
Awesome stuff. Someone said, can I contribute to an employee's HSA for the tax deduction?
You can contribute to their HSA and pay on their behalf, but you will also have to report it on their W-2 that they did have a HSA contribution made by the employer. So make sure it hits their W-2 as well.
It says, you mentioned 7 years old as a starting age. Is there jobs that younger kids can do for the same benefit?
You know, it's funny. When you can't start a Roth IRA prior to 7 years old. So, and you could check that with the investor and you could start planning with your investor, but the starting age for a child for a Roth IRA is 7 years old. Now, can you pay your child for something else? I have had clients that pay their children for marketing. And when I say that, it's because they put their children and their family on their website. So they do give them some kind of compensation there. And it's a way for them to have a little bit more tax deduction plus save for their children.
Awesome stuff.
You just got to make sure it's something within reason and you have it written down what exactly you're paying them for. Because if you have a newborn baby and you're saying they're cleaning the office, it's probably not going to work with the IRS.
Oh, come on, Olivia. I have a 6-month-old. I can't. Gotta take advantage of somehow.
You need to send her my way then.
Awesome stuff. And we do have some other just more random questions that we could just circle back to at the end.
Okay. And this is actually the end of the slides.
Okay, perfect. Awesome stuff. So
Oh, no, I'm sorry. I almost forgot the number one $1 million question. The $1 million question: how do I take care of that $215,000 taxable income? Do I run out, buy a vehicle? Do I go get equipment? Do I make a major purchase because I don't want to pay taxes? Great question. I would say I would start with questions. Do you need the equipment? Is it necessary? Were you thinking about making the purchase? And some of the clients will say, I was actually going to buy it next season before we start the business again in 2025. Something like that, I would say, yes, of course, go make the purchase then, because it makes sense for you to do it this year because you're in a higher tax bracket. Another question would be, is it going to be beneficial? Is it going to make you run jobs more efficient? Are you going to make more money? Are you going to be able to do the job in maybe half the amount of time and then take on more work? Something like that, I would say yes again. It makes sense. But if it's not necessary, I would say no. Because if it's just, I wanted a truck just to have a truck, and maybe this is something I can do, but you don't necessarily need it, I'm going to go with the no. And the reason I say that is because if we have a taxable income of $100,000, let's say you're in an 18% tax bracket, you're paying $18,000 taxes, but you still have a cash flow of $82,000. So that's $82,000 that's cash on hand, whether it's in the operating account or you took it as a distribution. Now, with an asset purchase that you may not necessarily need, if you made an asset purchase of $60,000 here, your taxable income is now $40,000, which is your $100,000 minus the $60,000 purchase. So on $40,000, maybe now you're in a lower tax bracket at 16% versus 18%. So your tax would be $6,400 here. You do have a tax savings of $11,600, which would be your $18,000 here on $100,000 minus your $6,400 that you saved. So you do have his tax savings here. But what I want to point out is that your cash flow, your taxable income of $100,000 here, and I highlighted here in yellow your major purchase of $60,000. That $60,000 is either going to reduce your cash or you're going to have finance on that $60,000 because maybe you don't want to use $60,000 cash and you want to be comfortable having a little bit of cash on hand, so you finance. Then you minus your tax that you paid, the $6,400 as above here listed at the 16%. Now your cash flow is $33,600. I don't know about most people, but I'd rather have $82,000, pay $18,000 tax than to be stuck with only $33,000 cash on hand, just to save $11,000. So something like that, I say if it's not necessary, pay the taxes. Let's figure out how we could pay the taxes, because an example like this, it's costing you more money trying to save just $11,000 because now you just went out and you spent $60,000. And on the finance, that $60,000 could really be more than that, because if you finance, you have your loan fees, you have interest, and then you have the interest over the next 3 to 7 years, however long you finance the loan.
No, that's great. I think there's a big misconception, you have a high profit. Okay, what should I purchase next? Now I have to run out and purchase something, big truck or a skid steer or whatever it is. And like you said, if you need it and if the cash flow was there and if you were going to purchase it anyway, go ahead. But just like this example helps us see, you're really not going to be saving that much in taxes. And like you said, the cash flow is a major consideration when it comes to this too. So I appreciate you breaking that down, Olivia.
Yeah, thank you.
Awesome.
And I've had this conversation with multiple business owners over the years, and especially recently, now that we're at the end of the year here, and I'm booking up with my tax planning meetings, that if it makes sense, yes. If it doesn't, I don't know who doesn't like money.
Cash is king. Okay, alrighty. Yeah, if anybody has any last minute questions, please ask in the chat. But here's our contact information, my email, and then phone number. You can also visit us at cyclecpa.com and schedule a call there with us if you'd like. But we'll stay on. If you guys have any questions, please feel free to email us too. We'll be happy to answer them as well. But I'll go back through, comb through some of the other questions that we didn't go through, Olivia. Someone said, do I 1099 the landlord who I pay rent to?
You should. Yes.
Okay. If we could quick list off some advantages of being an S Corp versus a C Corporation.
The advantages of S Corp versus C Corp?
Yeah.
C Corp, you're double taxed. And whatever the profit is in the C Corp, you're taxed at, right now it's a 21% flat rate.
Mm-hmm.
But any distributions you take from the C Corp is considered dividends. So now those dividends, the distribution that you take, you have to record it being taxed again on your personal tax return. And that's at a high tax rate of 20%. So that's one of the benefits of being an S Corp is that you're taxed only one time. You're taxed on the profit and it's on your personal level. You could be in a higher tax bracket. So maybe you're in a 22% versus 21%, but your distributions are not being taxed. And that extra distribution that you took from the C Corp is coming through, and let's call it 50,000, is coming through and maybe it's taxed at 15%. Well, you already paid 21% on the profit. Now you're paying 15% on your distribution. So that's 36% that you just got taxed on. And as an S Corp, you get taxed on your profit at your tax bracket level, but your distributions have no additional taxes. You could take the distribution as part of the profit and it just flows through to your personal.
Some stuff.
The only thing I will point out is a C Corp versus an S Corp as well. S Corps, they're made for shareholders that are under 100 shareholders. And also you have to be a U.S. citizen to be an S Corp. Otherwise, you have to default to a C Corp or a partnership.
Awesome stuff. Then someone said, I'm a new LLC owner and don't know much about filing taxes. Where do I start?
You could probably start by calling me and we could do a tax planning. So that way we could get you situated. But I would say, one, you're going to have to, honestly, as an LLC, you're going to have your accounting up to date. So hopefully you have something such as QuickBooks Online, you have some kind of accounting software, and then that's where your beginning part will be, is having your books done. And then you do have to file those taxes, and you do have to make an appointment with your tax accountant or a preparer. So that would be the beginning part. And also get your last year's tax return, because that last year's tax return is going to be what your tax preparer will need.
Awesome stuff. Yeah. I think it's also, if this is your first year, you probably contributed some equipment or even cash to this business. So a lot of people may have had a trailer or mower that they were using personally or in the past that they're not contributing to this business that they just opened. So making sure that you have a good listing of that of records on your end, so you can tell your tax accountant so that they could put these items, even though you personally contributed it can still go on your fixed asset schedule in your taxes. So that way you can claim depreciation on some of those things. Yeah. Awesome stuff.
I do see a question here. For the fuel tax credit, can all business structures claim it? Yes. If you're a sole proprietor, if you're a S Corp partnership, the fuel tax credit is available for all business.
And then someone said, were we speaking about net income or revenue when we were going over the tax situation? But we were talking about net income. We're always talking about net income. So after tax, so your revenue after all the expenses taken out from the business, the net, yeah. Awesome stuff.
I do see a question. Is it beneficial to put equipment in a separate entity and lease it to your business? I wouldn't recommend it unless you're building some kind of equipment rental and then you don't want the exposure. And when I say that, if you have equipment, but you want to rent out not only to your business, but to other businesses, then something like that would be entertained, because if somebody rents your equipment, they get hurt or they misuse it, they can come back and sue your company. And you definitely don't want it to touch your landscaping company. So a situation like that, yes. In a situation that it's only you using your equipment and it's only your business, I would say no. Because the only thing you're doing is you're adding additional tax filing.
Agreed. Awesome stuff. Alrighty. That is all the time we have today. But if you guys didn't get to ask your question, you could always feel free to email me and we'll try to, answer the best as we can. But I appreciate everybody coming on onto this webinar. And please let me know if there's anything else I can help you guys with. But I hope you guys have a nice evening here. Thank you.
Bye.
Bye.